$59.32. Silver just shattered every record on the board. And here's what hit me immediately. While this was happening, JPMorgan reportedly shifted around 169 million ounces straight into their vaults. Industry sources say that's roughly 9% of global annual supply. They've been stacking this metal since 2011, 14 years, quietly. And I keep asking the same thing. If silver is as irrelevant as so many experts claim, why would the most powerful bank in the country be loading up like this? My theory, something bigger is forming underneath the surface. And I want to walk you through a pattern I've studied for years, one that shows up in every major financial crisis we've lived through, a pattern that has never failed to appear. And in my view, we might be watching it finish right now, in real time. You still have a choice. But that window might be closing faster than you're ready for. I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned. This is educational analysis based solely on publicly available information. And after spending months digging through historical financial breakdowns, I kept seeing the same thing. They all follow one structure, 4 stages, always 4. And here's what unsettles me. Silver looks like it's sitting in stage 4 right now. Let me walk you through how I see it. Stage 1 is what I call the setup. Authorities create something that looks like stability. Prices get pushed down. Paper instruments flood the system. Everything appears calm. People trust the structure. For silver, this began after the fallout from the Hunt brothers in 1980. Regulators were spooked by the volatility, so they built something enormous. A paper market some analysts estimate is close to 50 times larger than the actual physical silver available. And here's the part that really hits me. Published COMEX data shows open interest at roughly 244% of vaulted silver. Sit with that for a moment. That means, just by basic arithmetic, if even half the contract holders requested physical delivery, the system could feel real pressure. Stage 2 is expansion. The distance between paper promises and physical reality widens. Debt grows. Liquidity injections arrive. Layers of commitments stack on top of earlier commitments. But prices stay suppressed. In my view, we've been deep in stage 2 since 2008. Reports suggest global central banks created more than $30 trillion. The US alone added around $8 trillion to its balance sheet. And yet, silver didn't explode. Why? Here's how I interpret it. Whenever physical demand picked up, major banks reportedly increased the flow of paper contracts, shorts, derivatives, hedges. Market data shows prices held below $30 for almost an entire decade. Meanwhile, something else was happening in the background. Industrial demand kept accelerating. Solar panels rely on silver for conductivity. EVs require roughly 3 times more silver than traditional vehicles. 5G networks, AI data centers, medical tech, all of it needs silver. Industry reports now suggest industrial users represent around 59% of total silver demand, up from roughly 40% just 10 years ago. And here's the part that concerns me most. Mine supply hasn't kept up. Data from mining reports shows output has fallen roughly 7% since 2016. Analysts describe this as a structural deficit, meaning more silver is being consumed than mined for around 7 straight years. So the question becomes, where is the difference coming from? Above-ground stockpiles, vaults, reserves, they're being drawn down. India's imports reportedly hit all-time highs. China has been purchasing steadily, yet paper prices stayed suppressed, until recently. And now we get to the part that fascinates me. Multiple market reports indicate that since around April 2011, JPMorgan has accumulated what some analysts estimate at roughly 675 million ounces of physical silver. If those estimates are accurate, that could equal close to 45% of the world's above-ground supply in 1,000-ounce bars. Let me put that into perspective. That's reportedly more than the Hunt brothers controlled at their peak, more than Berkshire Hathaway ever owned, more than what many nations hold. Why would they do this? Here's how I understand it. Back in 2010, JPMorgan reportedly settled manipulation-related allegations for roughly $200 million. And when they absorbed Bear Stearns in 2008, they inherited sizable short positions. For years, according to market observers, they were positioned on the wrong side of the trade. So, what did they do? The interpretation many analysts share is simple. They flipped, covered the shorts, and went long, massively long. Recent COMEX filings suggest they now hold around 169 million ounces in their vaults alone, which could represent roughly 40% of total COMEX inventories. And in my view, the gap between the paper world and the physical world has never been wider. Stage 3 is what I call the break. Something gives. It might be technical, it might be political, but suddenly everyone wants the real thing, the physical asset, not the paper claim. And there isn't enough to go around. And here's what makes me uneasy. I think we're watching Stage 3 unfold right now. Let me show you why. On November 28, 2025, CME Group, the exchange overseeing derivatives, reportedly went offline due to what they described as a server cooling issue. Reports indicate the outage lasted more than 10 hours. During that downtime, trading data shows silver spiked to around $56.72 per ounce, a record at that moment. When systems came back, market observers noted bid-ask spreads wider than $1. I'm not a professional trader, but that looks like disorder. That's illiquidity. That's the stress you see when a paper-heavy market starts cracking. And just days later, something else caught my eye. COMEX filings show JPMorgan reclassified approximately 134 million ounces from registered to eligible status. Here's why that matters. Registered silver can be delivered against futures contracts. Eligible silver is simply stored, not available for delivery. Think about that timing. JPMorgan reportedly removed around 9% of deliverable silver from circulation during peak demand for physical metal. That signals something. In October 2025, market data indicated silver lease rates hit roughly 30% annualized, meaning users were willing to pay the equivalent of 30% interest just to borrow silver. That isn't normal. That's what the beginning of a squeeze looks like. And now, here we are, December 6th, 2025. Silver surges into the $59 range. Reports suggest that's roughly a 98% move year to date, the strongest annual performance since 1980. Stage 4 is what I call eruption. Price detonates, shorts get steamrolled. Institutions positioned early walk away with the win. Everyone else scrambles. That's where I believe we are right now. And this is where history matters. Let me take you back to Texas. 1979, two billionaire brothers, Nelson and William Hunt. They watched silver trade near $6 an ounce and recognized something others ignored. Inflation accelerating, consumption outrunning production, and a perfect storm forming beneath the surface. They went on to buy roughly 200 million ounces, nearly a third of America's entire silver supply at the time. Then January 1980 arrived. Historical data shows silver ran to $49.45. That's an 800% move in just 18 months. Banks panicked. COMEX rewrote the rulebook overnight. New long positions banned, liquidation only, Silver Thursday, March 27, 1980, collapse. The hunts were wiped out. But here's the part most people forget. The squeeze was real, the shortage was real, and the $49 price was real. It took changing the entire playing field to stop it. Now imagine this with me. What if the buyers weren't two highly leveraged billionaires? What if the entity accumulating was one of the institutions that helped shape the rules themselves? That possibility might be closer to our current reality than people think. 2008 delivered a similar lesson. Paper mortgage products imploded when everyone tried to convert into real assets at the same time. Historical pricing shows gold trading around $720 an ounce in October 2008, then reaching about $1,923 by September 2011, roughly a 167% rise. Why? In my view, when confidence in paper structures collapses, capital seeks tangible value: gold, silver, real assets. And here's what troubles me about 2008. Central banks didn't correct the underlying imbalance. They amplified it. Reports suggest they injected close to $16 trillion globally. They bought their own debt. They forced interest rates to zero. They expanded paper markets even further, which brings us to right now. Silver is consolidating under the $60 mark. But let's talk about what happens if it breaks through. According to earlier projections attributed to JPMorgan, silver was expected to reach around $38 by late 2025. We're already more than $20 above that. Citi analysts reportedly forecasted 36 to 39. Those targets are gone. Independent voices like Lawrence Lepard have mentioned ranges of 75 to 90 by the end of 2026. But those are the conservative views. Those numbers assume the paper market stays intact. What if it doesn't? Remember the hunts? Silver reached roughly $49 in 1980. Adjust that for inflation, and you get about $170 in today's dollars. We're sitting near $59. But here's the problem. The deficit appears worse today. Industrial demand is significantly higher today, and the paper market is exponentially larger today. Historically, silver has traded against gold at around a 15-to-1 ratio. Recent data shows the ratio hovering close to 72-to-1. When that ratio corrects, and historically it always has, some analysts estimate silver could push toward $280 an ounce purely from ratio reversion. I'm not saying any of this is guaranteed. We don't need conspiracy theories. What we need is what economists call mean reversion. And mean reversion tends to arrive whether you expect it or not. So ask yourself, what happens when holders of paper silver contracts request physical metal? What happens when they discover there may not be enough to satisfy every claim? What happens when pension funds, sovereign wealth funds, and everyday investors all try to secure physical silver at the same time? That's the scenario that keeps me up at night. 3 days from now, December 9th and 10th, 2025, the Federal Reserve meets to decide on interest rates. Bloomberg data places the probability of a rate cut at roughly 87.2%. Here's how I think about it. If they cut, the dollar typically weakens. And when the dollar weakens, gold and silver historically surge. Gold is trading near $4,212 per ounce. Some analysts project $4,500 to $5,000 by mid-2026. Silver traditionally tracks gold's direction. It always has. But silver moves faster. More volatility, more acceleration. In my view, the Fed meeting could be the spark. The structural deficit is the tinder. JPMorgan's positioning might be the accelerant. And a stressed paper market could be the blast. All the components appear to be lining up. Physical silver is still available, for now. Dealer reports show premiums rising. Some note delays, but metal is still obtainable. That window may not stay open long. When the paper market comes under strain, when futures delivery becomes uncertain, premiums can erupt, 30, 40, 50% above spot, possibly more. Look at what happened during the 2020 COVID panic. Silver touched around $28 per ounce, yet physical coins reportedly sold for $45, a 60% premium. Now, imagine that pressure with silver at $100. I'm not saying this happens tomorrow, but it's probably not a decade away either. The Fed meets in 3 days. That's the first domino. Industrial demand keeps rising. That's constant force. COMEX inventories continue draining, according to reports. That's the countdown. When registered silver at COMEX falls below 50 million ounces, and it's reportedly around 113 million right now, the system could face real stress. At the current rate of depletion, we could be looking at 6 to 12 months, possibly sooner if demand accelerates. Here's what many people overlook. This isn't just about silver. Silver is the symptom. The dollar is the underlying issue. Since 1971, when Nixon closed the gold window, the dollar has been a pure fiat instrument, backed by confidence and economic output, not by physical reserves. And after more than 50 years of expansion, more than 50 years of deficits, some economists argue inflation has been obscured by methodological changes in CPI calculations. In my view, the bill may be coming due. Gold sits near $4,200, silver around $59. Energy costs continue climbing. Institutional capital is flowing into alternatives. The entire market seems to be flashing the same signal. Paper currencies face long-term pressure. Scarcity matters. And in my analysis, silver may be the most undervalued scarce asset on the board right now. Undervalued compared to gold. Undervalued compared to its industrial necessity. Undervalued compared to the pace of money creation. If that undervaluation corrects, if it does, the move could be substantial. In 1980, silver hit around $50. It took 45 years to break that level. 45 years of what some call suppression. 45 years of accumulation. 45 years of coiling. And now, here we are, $59 and moving. The Hunt brothers were early. They lost the battle. But they weren't wrong about the fundamentals. Now imagine they'd been patient. Imagine they had institutional backing instead of resistance from it. That might be JPMorgan today. They learned from the hunt's mistakes. They're not going to force a squeeze too quickly. They're not going to act recklessly. They may just let the market do what the market eventually does. And if silver reaches $100, then $150, then $200, if it does, they'll be positioned exactly where they want to be. The signals are everywhere. Record highs, structural deficits, bank accumulation, paper market strain, central bank meetings, global tension, all unfolding simultaneously. That's not coincidence. That's convergence. Stage 1, the setup. Finished. Stage 2, expansion and debasement. Finished. Stage 3, the break, happening now. Stage 4, the outcome, loading. You don't have to take my word for it, but you should study history. And history has a way of circling back. I'm not a financial advisor. I'm someone who's been watching these cycles, following these markets, trying to understand what they're signaling. The silver moment isn't approaching. It's already here. The only real question is whether you'll recognize what's unfolding, or look back in 6 months wishing you had paid attention. The choice is yours. But think carefully. December 9th is 3 days away. If you want to follow this in real time, hit subscribe. I'll track developments and share my analysis as this situation evolves. And tell me, do you think silver hits $100 in 2026? Drop your thoughts in the comments. I genuinely want to know what you think. This could be one of the most important financial stories of 2025.